All right, welcome to Talk Tickers. Today we're diving into Star Equity's Q2 2025 earnings call, and let me tell you, this was a big one. This quarter really feels like a major turning point for the company. And you know, the whole story, it really just boils down to one single incredible number.
Yep, $1.86. That was their adjusted earnings per share. I mean, that's an over 800% beat versus what analysts were expecting. Just wow. But here's what really gets you. In the same quarter last year, they lost 29 cents a share. So this isn't just a little bit of growth. We're talking about a massive, massive swing from deep in the red to way, way in the black. It's a sign that something fundamental has changed here.
So here's our game plan for this breakdown. First, we're going to hit the numbers, because they were just a blowout. Then, we'll peek inside their playbook and figure out how in the world they did it. After that, we've got to talk about the Hudson merger, which is a brand new catalyst. And to wrap it all up, we'll give you our take in our next call segment.
Okay, let's get right into it with the numbers. And look, this wasn't just a good quarter. No, this was a statement quarter. I mean, the results across the board are screaming that this company is finally hitting its stride and completely changing its story.
I mean, just look at this table. The consistency is what's really remarkable. You've got revenue jumping almost 76%. Gross profit, it nearly tripled, up 182%. And check out the adjusted EBITDA. It went from a $500,000 loss to a $7 million gain. You don't have to be a Wall Street genius to see what's happening. Every single metric is pointing in the exact same direction. This is a dramatic, profitable turnaround.
And let's just zero in on that revenue number for a second. That jumped to $23.7 million. It didn't just beat estimates, it absolutely crushed them by over 35%. This wasn't a small win, it was a total blowout. It tells you the market completely underestimated the momentum they had. So of course, the big question is, where did all this growth come from? And more importantly, can they keep it up? Well, a big part of the answer is right here, the backlog. The company is sitting on $25.7 million in future work just in its Building Solutions division. That's almost double what they had a year ago. Management was pretty clear on the call. This gives them huge confidence, not just for the rest of this year, but for a really strong start to 2026. So, you know, this isn't some one-hit wonder. This is real, contracted revenue that's already in the bag. So, the question remains, how exactly did they pull this off? Let's dive into their playbook. It really seems to be a powerful mix of solid organic growth and some really smart strategic moves. It wasn't just one thing, that's for sure. First, you've got strong organic growth from their core building business. Then, you layer on the contributions from a couple of recent acquisitions, Timber Technologies and Alliance Drilling Tools, which, by the way, are high-margin businesses. And then, the cherry on top, their investment arm cashed in big with a $5.5 million gain on an investment. It's like they're just firing on all cylinders right now, growing the core business, making smart buys, and managing their money well.
And you know, this quote from the CEO, Rick Coleman, during the Q&A, it's super telling. He said, "We've seen very little restriction on our ability to gently raise prices in the energy services division." Now think about that. A lot of other companies in this space are getting squeezed on pricing right now. But Star Equity, they're actually able to raise prices. That tells you they've got something special, in-demand products, great service that lets them pretty much ignore the negative industry trends.
And here's the other side of the coin. It's not just that they're growing profitably. Their SG&A, their basic operating costs, dropped from 40% of revenue all the way down to 27%. That's a huge deal. It's what we call operational leverage. As their sales go up, their costs are growing much, much slower. All that extra money just falls straight to the bottom line. It's just a classic sign of a really well-run company. Okay, so this is where the story takes a really interesting turn. The turnaround part? That's pretty much in the rearview mirror. Now the whole narrative is shifting. Thanks to the just-closed merger with Hudson Global, Star Equity is moving from being a turnaround story to a full-on scale-up story.
And boy, they did not waste any time. The deal was announced in May, shareholders gave a thumbs up on August 21st, and boom, it was officially done the very next day. That kind of speed tells you everything you need to know about this management team. They're focused, they're not messing around, and they're executing their plan.
So, you might be asking, what's the big deal with this merger? Well, it does a few really important things. It makes them a bigger company, it diversifies where their money comes from, and, this is key, it lets them get rid of a bunch of redundant costs. Things like paying for 2 separate audits, 2 boards, 2 stock listings. All that goes away. It creates a much bigger, more efficient platform for them to keep growing from. And we're not talking about pocket change here.
Those cost savings are real. Management is on the record saying they expect to slash $2 million a year in corporate overhead, and they think they can get it all done within 12 months. That's $2 million that's going to go directly to the bottom line of this new combined company. That's a real, measurable impact.
All right, that brings us to our final segment, what we call the next call. We've looked at the amazing numbers, we've broken down the strategy, and we've talked about the big new merger. Now it's time to put it all together and see what it means for the future. So after all that, what's the trade? How should you be thinking about this company now, after such a huge quarter and a game-changing merger? Here at Talk Tickers, our rating is outperform. And our thesis is pretty straightforward, broken down into 4 key points. 1, we just don't think the market has fully priced in the benefits of that Hudson merger, especially those $2 million in savings. 2, that huge $25.7 million backlog basically de-risks the next few quarters. That revenue is practically guaranteed. 3, the way their margins are expanding shows this isn't a one-time thing. Their execution is for real. And finally, number 4, management has officially switched from playing defense to playing offense. The turnaround is over, now it's all about growth.
And it looks like the market is starting to wake up to this. Since they announced these earnings, the stock is already up around 27%. That's a pretty clear signal that investors are starting to see this major inflection point and are revaluing the company. The secret, it seems, is starting to get out.
And as always, just a reminder, this is not financial advice.